Welcome to This Week in Money. I'm Jim Goddard. Today, Chartworks CEO Ross Clark tells us about the confusion over the U.S. policy on the value of their dollar. Author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, talks about the future of Vancouver and Canadian real estate. He discusses the impact of the new mortgage stress test on the market. Editor of the popular blog Juggling Dynamite, Danielle warns about all the debt and asset bubbles that are growing. She's also concerned about the attack on net neutrality. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and the President of Glance Technologies, Penny Green. We'll talk to Ross Clark right after this.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is the CEO of Chartworks, Ross Clark. Welcome back to the show, Ross.
Always a pleasure, Jim.
What's the official U.S. policy on the value of their dollar?
Well, it depends upon what hour of the day and what day of the week it is. By middle of the week, we had the U.S. Treasury Secretary Mnuchin talking about how they would love to have a weak dollar, so he's talking it down. They turn around the next day, and there's Trump saying, no, I'd like a strong dollar. So, you know, this administration, you just have to go with the flow. Now, from a technical perspective, and that's where I do my work, because when I start to delve into the fundamentals, that's where I get myself in trouble. So from a technical perspective, the dollar had that retest of important support at the tail end of the year, had a bit of a bounce, and it really had the opportunity to create a double bottom against that September low and get a bit of a turn. But there was no sign of strength. It couldn't get back even to where it had just recently broken down from at the 92.5 level. We needed to see it get through 93.5 to see that there was any real change of character and some strength coming. The break then during this week took us down into the next level of oversold conditions, getting to the bottom end of a channel we've been going down in for the last, year, maybe 13, 14 months, getting towards the bottom end of that. So you could be looking for another bounce, but unless it gets back above 92 on the index, it's still in a very decided downtrend. And with this break that we've had in the dollar index, you've got the reciprocal action in all of the commodities, whether it be the oil market, the precious metals, you just name it. Gold had a great run here. I think we were at 29 days to the top of the run by the Thursday from as far as the seasonal pattern is concerned. And that one, on average, peaks out around the 44th business day. Can be as early as 23, so we're getting a little long in the tooth on this one. We're definitely recommending to people who were buyers back in December when there were good bargains out there that they raise their stops, looking at the 1334 level on gold, and that was the middle of that last little consolidation we had here a week and a half ago. That, to us, for speculators, becomes a key stop-loss level, I would say.
What's going on in the bond market?
Bonds, we had major downside capitulation in that one just over a year ago. And you invariably will come back, and I say invariably, this is going back, looking at the last 50 years of bond data. When we get that hard oversold, this was then the fourth time that we've had it, you will come back about a year later and do a retest of that support, which is exactly where we are January now. You're testing that same low. There's a major uptrend line. Part of this move that we've had in the bond market for, since the 1980-81, when interest rates were up at the, 18% level. We've had this declining interest rate structure. The bonds are at a very, very important support line. And when you've had that support line tested with the test of the oversold, every single time it's reversed higher the following month. So that would be February that we want to be looking at. That's going to be a real critical juncture for us, because if it doesn't turn there, we've got a whole new change of character, and that then clearly implies that the declining interest rate structure that we've been in, which everyone has been thinking might be coming to an end, that would be proof of the pudding as far as we're concerned. Another important thing that we were looking at this week in terms of the equity market, we like to look at big pictures, big corrections. Like if you take a look at the 2007 to 2009 decline in the markets, and you look for retracements of that. I mean, typically you would look at 50%, maybe a Fibonacci 62%. But then if you look at the upsides, like if they retrace more than that, if they retrace 160% or 260%, you find that there are important resistance levels. And if you look at the Dow coming off that 2009 low, the tops that we had in 2015, where we then got stuck for a year and a half to 2 years, that was right at the 161% level. And why I'm mentioning this now is that we are within 100 points of that next level, a 261-pointer. So this type of level that we're seeing on the Dow right now is, from our perspective, a pretty good level to be looking for some significant resistance.
Ross, thank you so much for chatting with us.
Always nice to be with you, Jim.
My guest has been Chartworks CEO Ross Clark. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be on your show.
Canada now has what they call Bill B20. It became law January 1st. What is B20 and how could it affect Canadian real estate?
So what those B20, and there's also a B21, they're actually guidelines that are put out by OSFI, which is the regulator of the federally regulated financial institutions, mostly the banks, but it does catch some other companies, and a few of the credit unions are big enough that they're. Anyway, what the guidelines are designed to do is to give the lenders a sense of the rules as to what they're supposed to use to decide whether somebody qualifies for a mortgage. And under CMHC, which is the B21 guidelines, they tightened things up quite dramatically. And so what happened was the CMHC insured, which is the insurance, government-sponsored insurance for mortgages, protecting the lenders from default. The tightening up on the B21 guidelines meant that people started to shift to the non-insured mortgages, which is, the difference there was you have to have a 20% down payment or greater to qualify to be a non-insured mortgage. And people were going and through various means, going to the bank of mom and dad, maxing out their credit cards, going and finding some shadow bank lender. There's all kinds of different ways to do it in order to get the 20% down payment. And then they got out of the tightened rules under the insured mortgages. And so then, they should have seen this coming, but maybe they did. But anyway, they realized, wow, look at the growth. And it was just exponential growth in the uninsured mortgage space, which then led them to realize that they're going to have to tighten up the uninsured, which is where B20 came in. So in about October, they said, okay, all those rules for the insured space, in CMHC and other insurers, in terms of what you have to have, how much income you have to have, and all this stuff, and what the interest rates are and everything, we're going to apply that to the uninsured space. And that really set the cat among the pigeons, as they say, because that closed that loophole. Now, the banks have a lot more flexibility than, say, your local credit union and that, in terms of I shouldn't say bending the rules. They've got some flexibility within their guidelines as to what they can do, but the loopholes as they existed have been dramatically tightened, and it is, I suspect, starting to bite, especially on the more expensive homes, because you now have to qualify at basically the rate now is over 5%. So you have to go show your income, whether it's T4 or whatever they ask for, and come with your 20% down payment, and then they say, okay, can you really afford this mortgage? And they have to imagine as if you were paying interest of 5.1%. And it isn't a whole lot higher than 5.1%. It's actually about 6.5%, where people are paying double the purchase price of the house in interest on their mortgage. So if you're buying a $500,000 house, you're paying 6.5% mortgage over 25 years on average, which isn't as far-fetched anymore as it was a couple of years ago. You would end up paying $1 million in total to repay that loan, which is, you look at that house and say, wow, am I going to pay an extra $500,000 in interest for the privilege of owning this home? Is it really worth it? I don't know if it's worth it. So now they're asking people to qualify at a higher rate, even if they're getting a mortgage at 3%, they have to pretend that they're paying 5.1%, and that's going to make it a lot tougher for people to qualify to buy houses.
Are banks tightening mortgage lending?
Well, within the context of that discussion, in other words, the rules that are applied by the regulator, they're certainly going to apply those. They don't really have a lot of choice about that. But as I mentioned a minute ago, they do have some flexibility, and the banks have enjoyed basically a 20-year run of growth, which is just a phenomenal run in terms of mortgage growth and HELOC growth and credit card growth and auto loans growth. And nobody wants to show, since basically all of the big lenders are publicly traded on the stock market, nobody wants to show a decline in growth. So the growth was 10% per year at the peak, and now it's about 5 or 6% per year. But I don't think they're volunteering. I don't think they wouldn't voluntarily slow the growth in mortgage debt in Canada. But I think the effect of these new rules, plus a few other changes in how banks' capital is regulated, will have the impact that the mortgage growth will slow. And my opinion is just, this is a forecast. It isn't real. yet, but the mortgage growth will actually go negative at some point, as it did in the U.S. during after the global financial crisis. And of course, mortgage growth can't go negative without a recession. You know, it's a big part of our economy. It's a big part of our growth in our economy. So if mortgage growth goes negative, even 1 or 2%, that would mean a recession in Canada.
In the early 80s, interest rates doubled from 10 to 20%. Compared to the recent mortgage rate low and today's rate allowing for B20, is the increase in mortgage payments today comparable to the early 80s?
Well, you know, it is actually, and the reason that, I know it's hard to imagine, but the actual mortgage rate that you could get never hit 20%, and you know, unless you're like a really flaky borrower. But most of the people could get a mortgage that maxed out around 14, 15%. I remember having one that's 13.4% myself. And but remember, at that time, the inflation rate was, well, for 2 years it was 10.5%, and 1 year it actually went over 12%. So if you're borrowing at, say, 15%, and the inflation rate is 12%, just to pick a number, you're actually only paying 3% above inflation. And so today, inflation's 1.5%, maybe 2%, depending on how you measure it, and mortgage rates are 4 or 5%. It's actually very similar. The difference back then in the 80s, which was very positive for people buying houses, was wages were going up rapidly. I talked to a guy just the other day who reminded me that he was paying those kind of interest rates on his mortgage, but his wages, and when he got promoted, and cost of living adjustments, we used to have those, were going up quite a bit faster than 10% per year. So 5 years later, he was making a lot more money, and the mortgage didn't seem like as bigger problem. Today, it's much harder because we're not getting those wages. At least most people are not getting those wage increases. So even 5% interest today, and if it went up to 6 or 7%, would be equivalent to mortgage rates going from 10 to 15% back in the 80s.
The average house in Vancouver costs over 12 times what the average family earns. To normalize the number, how far would real estate in Vancouver have to fall?
Well, you can't normalize Vancouver. Vancouver will never be normal. There's a reason they called it Lotus Land about 30 years ago. Famous broadcaster and well-known personality coined it with that term. However, the average, to answer your question, the average, if it were to happen, is 3 to 4 times. So 12 times down to 3 or 4 times, you're talking about a 75% drop in housing prices. Now, it's hard to visualize that. The average in Canada, which also used to be 3 to 4 times, is now up at 5 or 6 times. So that would indicate about a 30 to 40% drop, which is what I expect. But you know, if you get into $4 and $5 million houses in very expensive parts of cities like Toronto and Vancouver, and even in Edmonton and Calgary, those houses, if there's no buyers and the seller were forced to sell for some reason, you certainly could see declines of 50. We're already seeing that in Calgary and Edmonton, where $2 million houses are going for $1.1 million, that sort of thing, which is almost 50% haircut. But the average price, which would include all condos and lower price stuff, I think a crash, anything above 30% is going to be considered a crash, and a 50% decline would be a really once in a lifetime kind of crash for Vancouver. But the answer to your question is it would have to be 75% to get it back to normal. As somebody said, normal doesn't live here anymore, so that's probably the way to look at it.
I don't know. I've been in Vancouver since 1982. No, it's never been normal. It's
never been normal.
It's always been super expensive.
Yeah.
Is the Vancouver real estate bubble bigger than any of the American cities prior to the U.S. housing crash?
Yes, it is. It's there's really no parallel. There's only 2 places in the world really that compare to Vancouver, and that is Sydney, Australia, and Hong Kong. And Hong Kong is a very special place in the sense that there are a very large number of very high-paying jobs in Hong Kong, and of course the mainland Chinese wealthy people use Hong Kong as a way of getting their money out of China, and so it's a very unusual situation. It's a very small place, crowded with a whole bunch of very, very high income people. And of course, as people know, the income tax rate in Hong Kong is 11% on income, and it's 0% on capital gains. So it's always going to be an expensive place. But Hong Kong real estate has had crashes of more than 50% several times in the last 30 years, not just once, but several times. And in Sydney, now Sydney is probably more comparable. So in other words, Hong Kong, even though the ratio is similar, I think it's actually 14 times in Hong Kong. It's comparable to Vancouver, but it's such a different situation that it's not really comparable. But Sydney is comparable, and Sydney is in the same kind of range, 10, 12 times, depending on how you measure it. Same kind of economy, resource-based income, some head offices, financial center, as well as a few of these other things. And Sydney has not had a correction now of any substantial size for probably 20 years, because they haven't had a recession in Australia for more than 20 years. So that's the real comparison. And those two are the two most expensive kind of normal cities, if you like, in the world. There are a few places like Monaco or Luxembourg or something where you might find some crazy things going on, but so Vancouver's, if it's not the most expensive city in the world, it's in the top 3.
We'll have more with Hilliard MacBeth when This Week in Money returns.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. I'm speaking with Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. Hilliard, governments have tried to intervene in real estate markets with taxes on foreign buyers, taxes on empty homes in Vancouver, and speculation taxes. Are these tax grabs that could contribute to a market collapse? And do efforts by the government actually affect property values?
I think the more important government changes that affect property values are more likely to be the things we talked about earlier, the B20 and the B21 guidelines, and especially how the banks are regulated in terms of what leverage ratios the banks can use. Because it's not well known, but I do talk about it in my book. The banks in Canada are allowed to use a very high leverage ratio when they're lending for housing, especially if it's insured by CMHC or one of the two other mortgage insurance companies, because the banks aren't taking much risk. So they're allowed to consider mortgages as zero risk weight or very low risk weight. And this is actually kind of unique in the world. So any kind of a tweak to that model would have a bigger impact on housing than things like foreign buyers. But, it appears that it's very easy to get around the foreign buyer tax and some of these other things like the empty house tax. It's fairly simple just to find somebody local who can use their name to buy the property, a student maybe or something like that, and avoid the foreigner label. But the other change that doesn't get mentioned as much, and I think it's fairly significant, is the anti-money laundering rules and the new requirement, which is about a year old now, that all transactions must be reported to the CRA, the Canadian Revenue Agency, and that's used to be that everybody would just claim the homeowner's exemption and not be subject to a capital gains tax on a sale. But now people are starting to they're being required to report it, even if you qualify for that exemption from tax on the sale. You still have to file a form and explain why you should qualify for that. And for most people, that's just going to be a little minor annoyance to file a form. But for some people who are kind of flying under the radar, it's going to be a game changer for them. So those are the kind of things that have a big impact. But, in Vancouver, for example, residential tax rates are extremely low compared to other cities like Edmonton and Calgary. So there's lots of room for taxes to go up on housing. And, of course, I imagine they're really low because the government doesn't need any more money. They've got lots of money coming in from the property tax. But there's lots of things that could be done. But really in the overall, these housing bubbles that have happened all over the world, it's almost always connected to a debt bubble where the lenders have decided to lend people a lot of money. In the U.S., it was based on people lying about their incomes, and apparently in Canada there's been some of that going on as well. Or it could be the government rules that allow the banks to lend a very large amount of money to people. We've talked before about anecdotal stories, which I believe now. I've heard it so many times, and I even checked with a bank and asked them flat out, what could a young couple that makes $200,000 a year borrow? And they said, $1 million, no problem. So that is not normal. Like, people don't realize that is only something that's happened in the last 3 or 4 years, maybe 5, 6 years. You go back 15, 20 years, 10 years, 30 years, no lenders would ever lend $1 million to a young couple. I mean, what if one of them loses their job? What if one of them gets pregnant? What if one of them, what if there's a divorce? I mean, it's unprecedented. Really, it is.
What do you see ahead for the Vancouver real estate market this year?
Well, I don't know about this year, but certainly in Toronto, I just got back last night from Toronto, and there's definitely a change happening there. There's in the core parts of Toronto, the prices don't seem to have changed much, and the big activity is in the condo market, and it's apparently exactly the same in Vancouver. The overhang on the market appears to be the expensive houses that, in the case of Vancouver, would have been on West Van, British Properties. And there's still a very large number of listings there, and apparently they're not moving much at all if they're above 2 million. And exactly the same thing in some of the parts of Toronto. And the other thing that I noticed when I was in Toronto was people are starting to talk about selling and renting, which, I was talking about this 3 years ago when the book first came out, and I just got blank stares when I mentioned that. Like, why would you do that? But nowadays, it's actually openly being discussed that, here you've got, if you happen to be lucky enough to have a $3 or $4 million home, because prices have gone up that much in a desirable part of Toronto or Vancouver, you could sell and you could rent and you could have a very nice investment account, which would fund your retirement and leave a little money for the kids afterwards too. So people were not talking about this even as recently as 2 years ago, but now they're starting to talk about it. So it seems like there's a change in the air, and I haven't been out to Vancouver for a few months, so I haven't had a chance to talk to people there, but certainly in other parts of Canada, there's definitely something happening. And it's a psychological change when prices start to go down is huge. Like, it's just, and it isn't just on the people that are thinking about buying who all of a sudden go, oh, wait a minute, maybe we should wait and see if prices are going to go down further. It also affects the lenders and everybody else in the system. The mortgage broker, the realtor, the lender, and the buyers and the sellers are all affected by the fact that for instance, in Toronto, from last April, prices in some parts of Toronto are down 20% or even more. So and we saw it in Edmonton and Calgary, and prices did not drop precipitously. They've just sort of been a kind of a long, slow, flat, slightly lower kind of a thing, which is odd given how severe the recession was in Alberta from a couple of years ago. But in Toronto, we're seeing something a little bit different. It's happening faster.
Are foreign real estate investors still attracted to Vancouver and Canada?
I don't know why they would be. Actually, it's like I get this argument all the time. People tell me, Hilliard, you're wrong about the coming real estate crash because there'll always be foreign investors interested in Canada. But really, I don't know why exactly that would be. It doesn't. I don't think there's anything that special about Canada. But maybe I'm wrong in that. But certainly, there's lots of stories. There's a story this morning out of Manhattan, and there's several stories over the last 6 months about London, England, that indicate that prices are softening quite dramatically in those two areas. So if I were a foreign investor and I had lots of money, I was sitting in China or in India or in Russia, and I was looking for a place to park some money, I wouldn't just look at Toronto and Vancouver. I would look at all of those places, and if the prices were coming down, I would be certainly inclined to think about London and Manhattan and those kind of places equally, if not more so, than Toronto and Vancouver. So I think those are stories we tell ourselves that somehow we're really special and people will always be interested. But if everybody's human beings are human beings, whether they're worth $30 million or $300,000. When they see prices dropping, they all react the same way. They say, "Oh, wait a minute, maybe I better hold off." And greed can turn to fear very quickly. So I think we've been caught in greed for about 15 years. So we'll see if it turns to fear, and if it does, then absolutely the foreign investor. In fact, I remember, it is so long since it happened, but I remember 10 or 15 years ago, people used to say foreign money was hot money, and hot money it was called hot money because it moves in fast and it moves out fast. It's a very skittish kind of a thing.
How is mortgage and consumer debt in Canada?
It's the highest it's ever been in Canada, and it's also when you compare it to other countries in the world, it's hard to find another place on the planet that has the kind of levels that we have. So if you include private sector, all private sector debt, so that includes corporate debt and household debt, Canada's been growing very fast, and it's up to 218% of GDP. So that means for every dollar of activity in the economy, as measured by gross domestic product, there's $2.18 of private sector debt, and that's one of the most elevated in the world. It might be the most elevated. I'm just the numbers move around a little bit, but it's right up there. And the other thing that, and this is more of a warning sign than the level. The level is a warning sign already. The threshold for danger by things like the Bank for International Settlements, based in Geneva, Switzerland, is 150% of GDP. So we're way above that. We're at 218%. We left that behind a long time ago. But the other thing they measure, which is perhaps even a more dangerous warning sign, is the rate of growth. So if you took 20 years to go from 150% to 218%, maybe it's not so bad because the economy can adjust to it and people can adjust. However, if you do that same kind of growth in the 5 years or less, which is basically what we've done, then it's a very strong warning sign. And in fact, different economists like Professor Steve Keen out of England, originally from Australia, now in England, and a fellow in Ottawa named David McDonald have done studies and indicated that there's never been our growth in private sector debt that rapid that hasn't been followed by a financial crisis. So it's very high, and it's a very dangerous situation.
Well, what happens when you have a federal government that's ramping up its deficit at a monstrous rate at a time when we're in good times? What happens when times turn bad?
Exactly. I mean, the one thing that we have in Canada, and this could save us, and it may or may not be enough to save us, but it could save us, is our federal debt is much lower than other comparables. So like the U.S. is sort of edging up close to 100% of GDP for federal government debt. In Canada, we're still sort of below 40%. I think the government actually uses a number down around 33%. But if you look a little deeper, it turns out we're not quite as as clean as we yeah, as you point out, for one thing, the deficit is quite large. It's running at about $18 billion a year, and but the second problem is provinces like Ontario and Quebec, and now even Alberta, are going into debt quite rapidly. So, and because none of those big provinces, or even small provinces for that matter, could default without the federal government, although it's not legally required. In practice, they would have to step in and backstop Ontario, especially, and Quebec and Alberta. It should be added actually to the federal debt. And if you add that in, then it turns out that we're quite comparable to the U.S. at around 80 or 90%. And then one thing that we have in Canada that they don't have in other countries is this mortgage insurance scheme, the CMHC, and that's another $500 billion. So that would add another 30% to the, if you counted that as debt. Now, it's not considered debt because it only is a contingent liability in the event that a bunch of people default on the mortgages on their houses, and that, the people would argue that that's not likely to happen. Some people would argue that. So you shouldn't really count that. However, it is a liability, but it's not considered in that, and other countries don't have that. So actually, the total of all of mortgage insurance, when you include the other private sector insurers, are also backstopped by the federal government, believe it or not, and the mortgage-backed securities and the Canada mortgage bond and all of that. If you add it all together, it's more like $1 trillion, which is about 50% of GDP. So now, of course, the government would never have to pay out on all of that, but even 10% of that would be $100 billion, which would be a big jump to the debt. So, and then you can get into pension plans and the difference between Social Security in the U.S. and Canada pension plan. And it turns out we're not really that different. But on the surface of it, it looks like we are in better shape at the federal government level. And one thing that has happened lately with the new president in the U.S., they've talked about NATO and the commitment to defense spending. And Canada's at 1%, and NATO, the suggestion by NATO is that every country in NATO should spend 2%. That would imply spending almost $20 billion more. We're currently spending about $18 billion, something like that. So our deficit would go from, the numbers are roughly the same, $18 billion is our deficit, and the amount we'd have to add to defense spending if we were to jump to our full NATO commitment would be a similar amount. So we'd double the deficit, but we're not going to do that, obviously. We're not going to go all the way from 1% to 2% right away. However, there appears to be a trend all over the world to, other than the U.S., who already spends huge amount on defense, for the other countries to be required to spend more on defense.
Hilliard, how can people get your book, When the Bubble Burst, Surviving the Canadian Real Estate Crash?
They can buy it at any of the best bookstores like Chapters and Indigo, and they can also buy it online from Amazon, and they can buy the Kindle version as well, the ebook, either Kindle or Kobo. It's available in all those formats. So they just type in either my name, Hilliard MacBeth, or When the Bubble. Now, When the Bubble Burst, you have to dig a little deeper because there's several books with similar titles, but you get to Canadian Real Estate Crash, and you'll find it quite easily.
Hilliard, thanks for being on the show.
Nice to be on your show again.
My guest has been Hilliard MacBeth, as we just mentioned, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. Coming up, Danielle Park, next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council, Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
You have on your blog the central bank debt trap. What is it and how bad is it?
We're all living it, Jim. We've been living it for many years now, but the hoopla at Davos, Switzerland, of course, this week is all the elites of the major, central banks and financial institutions head over, and they sit around and talk to each other. As Jamie Dimon says, it's where billionaires tell millionaires how the middle class feels. It's kind of one of the good quotes that has ever come from Jamie. But anyway, so one of the speakers was Bill White, and the reason I care about Bill White is he's the former chief economist for the Bank of International Settlements. We've talked about the Bank of International Settlements before in our calls. That is the board that meets in Europe, and it is populated by all of the main central bank heads from around the world. So Mario Draghi and, Janet Yellen and Mark Carney and all these people that are making all these decisions about, what funds to pump in and have been behind all the asset bubbles we've lived through for the past 20 years. They all get together, in their day jobs at the central banks. They never see a bubble, never see any trouble coming, never see any downturns coming, never concerned. Record debt has got higher and higher and higher over the last 20 years, and they never sound the alarm. But when they go over and have these meetings out of country, like an out-of-body experience at the Bank of International Settlement, they evidently they then sit around and tell each other how they really feel, and then they issue these statements warning everyone about the calamity of excessive debt, and asset bubbles are billowing, and it's all very dangerous. So it's a very dualistic schizophrenic approach that they take. But the former head of chief economist of the BIS is this William White. And he is sort of the poster child for, because I guess he was on the International Settlements Board, he was not restricted by a central bank in his home country in his comments. So he's been quite forthcoming over the years in calling a spade, in saying that there's rampant risk-taking at different points in the cycle, and saying that the system is fragile, that it hasn't been bolstered since 2008. It's actually been deteriorated. And so he comes to Davos, where everyone's congratulating each other on how genius they all are, because they've ridden the central bank liquidity wave up for 5 years. And as I say, it makes genius look, like everyone is, if you've been riding the wave. And no one's concerned, But his speech was one where he said, hey, the world financial system is the most overstretched since 2008. All the market indicators right now look exactly like they were before the Lehman Brothers collapse hit everyone broadsided and sparked the crisis that enveloped the world. He says, the optimism is, the most intoxicating at the top of every boom cycle. That's what we're seeing now. We've got record optimism in the CEOs that are attending. We have, horrendous measurements on every risk parameter, and yet we've got these talking heads still being super confident, as they always are, as they always will be. They never see a downturn coming. So it's an interesting sober. I can't imagine that Bill was very popular, at least in the mainstream. Now at the cocktail parties after, perhaps they, have a few drinks and expose how they really feel about things. But in their formal roles, these market leaders or financial institution leaders tend to be uber bullish at all times. But anyway, it's just, for people, like I've said before, I've been doing this job over 20 years now. I've always said it's like being the sober one in a family of alcoholics, where, they insist that you're the one that has the problem, right? None of them have any problem. It's just you as things get crazier and crazier. And so when you're devoted to evaluation discipline, when you take measurements, when you can add, you have a hard time being accepting the jolly, rosy forecasts of the perpetually bullish crowd because they don't do any work. They just call, always look for further upside, even if you're 9 years into the longest credit expansion, one of the longest expansion cycles in the economy ever. They don't ever think it's time to have a give back phase. But when you get someone like Bill White calling a spade, it's a cathartic moment for us realists because we say, oh, thank goodness, just as you were beginning to believe that maybe it is just you that's crazy, you get someone like that saying, my goodness, look at all the data. Of course it's as bad as it was just before the 2008 collapse. And that's kind of heartening for those of us who are still trying to hang on to, a bit of sanity, a bit of realism, and a bit of mathematics.
Taking a look at debt, one of the people I just talked to said Canada's federal government isn't too deeply in debt, but when you add in debts like Quebec or Ontario, Canadian governments are really deeply in debt. Is that a big concern?
Well, governments all around the world are deeply in debt because we've had the add debt and stir phenomenon for, a few decades now where, again, the only go-to solution for everything was just to add more credit to the system and inflate assets further. And in doing so, they were able to buy periods of relative prosperity or the appearance of prosperity, but it always adds to the tab. And of course, as you know, debt is cumulative and compound interest is cumulative and it kind of takes on a life of its own. So now we've got a world that all the countries have lots of debt, but at every possible level. So we have corporations the most indebted. They've been issuing the least the most covenant-light loans that they've ever done in many cases in the past couple of years in particular, where the people lending the money are requiring no assurance of any kind, like no security, very uncertain terms of payment, very long durations. I noticed, for example, in the last month or so, many of the companies and provinces that have been issuing debt have been doing so on 30-year windows again. So there's a lot of rolling over of debt in the world. And yes, the provinces have also been issuing long-dated bonds in the past few years, again, to capitalize on low rates. If they can get pensions who need to match their payouts with actual assets coming due, it makes sense to do so because they're doing so at very historically low rates. So yes, there's debt in the provinces and municipalities as well, but in a world where most things are unattractive for capital today because everything's been overvalued, because cash makes nothing, you have to make a relative assessment of where you are most likely, number one, to get your principal back, because that's something people have lost track of in the last year or so as Trump mania has gone crazy again and people are, the retail crowd is flooding back in to peak asset valuations. The same ones who did it in 07, 08, lost their shirt, left for a few years, and finally scraped up some savings to come back to the fore. They're doing so just in the last few months, at the highest level that we've seen in 30 years. Like just no cash left on the sidelines, just wild abandon, diving in. It's just a whole bunch of both statistical and anecdotal evidence that the retail crowd has finally gone full in again here. So as you're looking at that, you think, okay, well, we know many companies are going to have a hard time paying back what they borrowed in this manic cycle. We know that many households are going to have a hard time paying back in this manic cycle. So corporate debt tends to move up and down with the equity cycle and the credit expansion cycle and then implode with it as well. So you kind of want to stay clear of all that, to let the dust settle again and see, where defaults are going to rise. And then you have the government issuers. And the only reason that I feel that, of your relative choices, they remain a decent exposure is because they have access to a tax base. So, in many U.S. states right now, we've already seen a lot of pensions, for example, public pensions are coming into major solvency problems. Now, there the funding obligation falls back on the municipality or state in many of those cases, and they aren't allowed to actually go bankrupt. So what they're doing is they're increasing things like property taxes, where, the people who own the assets are going to have to pay more because the funding's got to come from somewhere. So, I think that, again, relatively speaking, the least credit risk right now has to be in the government issues, only because they have a greater pull and an ability to pull in tax revenue or increase rates if they need to during periods of downturn, whereas companies and households don't have that luxury.
Something that could cost us money, net neutrality, if it remains, is that a good deal? Or if the companies like Shaw and Rogers and Bell can get rid of net neutrality, will that keep our cable and phone bills down? What's the argument on both sides?
So I think, in terms of freedom of information, access to information, democracy, all those things, we'd love to have a free and open internet. I think the founding premise of it was this free exchange of information that would, accrue to the benefit of civilization generally, the advancement of knowledge and all that. So I think net neutrality is a key concept that many people see as critical to allowing those noble ideals to move forward. I think the big tricky part here is that in the push for internet and online access to information, many of the conventional ways of getting information are falling behind, like newspapers, like, journalism is in retreat in many parts of the world, like cable television. The statistics were something like $1 billion of revenue is going to be lost just in this year alone from people cutting their cable. I mean, I've done it, Roku boxes, all that. Who needs, to pay a fortune for cable every month anymore? So what's happening is that everybody wants endless access to internet, for their information, and people are dropping these other areas, home phones. Again, people are seeing that as irrelevant. Why need it if you've got a smartphone? No one's ever calling the house, that kind of thing. So that's all the trend for sure. The tricky part is they're losing major streams of revenue, and so this goes back to the same model as, some of the social media sites where they don't technically charge anyone for their service. It's all, quote, free, but then you discover that they've in fact been selling your information and putting you in harm's way to pay for these services. Same thing in the securitization market, the financial markets. Many things are presented to the public as, free, or, you don't pay for any of this. Meanwhile, they're cannibalizing your information, selling your flow, doing everything to make their profits under the table, so to speak, without any transparency. So I would much prefer if we can maintain the concept of net neutrality. I think it's very important. Instead of letting some providers, block our access to certain information, it gets to be a very slippery slope and concerning about who can control our access to information. This is almost like, who controls which books we're allowed to access, right? This is essentially what this argument is on the internet. So it's very troubling, but I think on the other hand, we may indeed have to pay up for this service for the reasons I've just said. There is massive infrastructure build out. Our appetite or consumption of bits and information has been, just going parabolic, and there is a lot of investment that has to go into maintaining that infrastructure. So I think we do need to think of it as a utility in support of the free flow of information in the world, and we probably have to pay more for the service to provide it, and more. And I would always vote for transparent fees, because then I can make an assessment about relative value, what's worth it for me, and it also encourages competition. When the public knows that this provider is providing this at this cost and this at another, these conglomerates who, have become massive, so we don't actually have any real competition, and are charging us a bunch of secretive fees and gouging money off us in ways we don't know. I think that model has really run its course.
Danielle, thank you so much for being on This Week in Money.
Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. She's the president of Venable Park Investment Counsel, Incorporated. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, and Danielle Park. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, and Danielle Park. Plus, a reminder at the end of the show, we'll have company showcase updates with American Manganese CEO Larry Reaugh and Glance Technology President Penny Green. If you have any questions for the show, you can email us at info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. My guest is Larry Reaugh, President and CEO of American Manganese. Welcome back to the show, Larry.
Thanks, Jim. It's always a pleasure to be on the show.
Cobalt still just being talked up like crazy. Some people are saying it could be the move of the year.
Well, it's already, I think, probably a significant move this year, certainly last year, and I can't see that lessening any at all. I mean, basically, there's no more new cobalt except for the Katanga that's coming on, and cobalt's going to be front and center here for the rest of this year. And I did say in the podcast last week that I expected it to hit $8,000. Well, guess what? While I was talking, it hit that, and or $80,000 a ton. So, I'm still forecasting higher prices. As far as I can see, that everything's adding up to much higher prices. So, cobalt is definitely the centerpiece on the table for most of the mining companies at this moment. Lithium enjoyed that spot for the last couple of years, and now it's cobalt's turn. Bloomberg are also talking about vanadium, and we haven't looked in that direction for recycling, but that is a direction that we certainly will look at. And I want to tell everybody that we will be doing, as funds become more available, we will be doing some R&D on other chemistries, just to see if our process would work on that. We know we got a winner in our hands right now, and that's what we want to try and get some cash flow out of as quickly as possible, so we won't have to go back to the markets for money all the time. And we did have, as I mentioned in the podcast last week, we did have interest in people wanting to put money if I was doing a financing. And I've, now I'm looking at a significant amount. So, and we have to do a financing, even if we're in talks with potential partners, that won't come around fast enough. We don't want to lose momentum, and I think that if we did a financing in the $1 million+ range currently, that we wouldn't have to finance again this year because we have warrants that are coming due that could give us a couple of $1 million before the end of the year. So I think that everything's coming up for a perfect storm for the company. Certainly, I expect that we will be picked up internationally by the investment funds as well as the interested parties in what we do, being the people that are involved in the industry, for example, or the financial news and Bloomberg. I imagine we'll start hitting the radar screens of other financial institutions. So I'm looking at a real bright future for the company. As you know, I'm off to California next week to the Bloomberg Mobility Conference, where I will be on a panel down there. And so the company's going to get really great exposure amongst about 300 registered attendees. I know they were going to try and stop it at 200, but they're up to 300 now. And so that's always a plus. I mean, you always walk away with some gain from anything you go to. For example, the conferences we went to earlier, some of the people that we're talking to today are contacting us from conferences we attended, and they heard us 3-4 months ago. And why is that? Well, the ground is shifting as I speak. The ground keeps shifting. It becomes more prominent that as I said in a podcast on the floor at the resource conference, we are not a alternate supply, but we would be part of the supply chain for cobalt, not alternate. That's a word from the past. And so I think, those that have been patient with the company will be rewarded this year. And I can't say exactly when, but we're not going to stay in this area forever. We might move up and down a little bit, but one day you can only hold a spring down so long, and it's going to, spring upwards. And that's the day I'm waiting for. It's going to take some sort of news, but we're the company that, creates the opportunity for news. So I think that will be forthcoming somewhere along the line. But I know I get criticized for doing financings, but I've only done 2 decent-sized financings since we started this program. And we had $900,000 worth of debt to pay off, which has been done. And there's still a small debt which is owed to myself and another director. But the basic thing is that, the money was well spent. Pay the debt, progress the property. Is no longer a proof of concept. It's more of a sure thing with the management here and with Chemetco that we do have the tiger by the tail, and the pilot plant will show that we can get it on a continuous basis, and we go from there. The other thing that's been hitting the market is other people, claiming that they're doing recycling and everything like that, and we had one from an international firm that claimed that they recycled lithium-ion batteries. They could do ores and everything else, and it made me think of an old saying, which I won't say because it's a bit vulgar, on the podcast here. But we try to follow up with these things. We find out their email doesn't work. Their site's one page, and and they're making claims that are basically, and a lot of the wording's the same as we use. So some of this stuff is false. Some of it is legitimate. There are people out there trying to get the handle on the recycling, and you'd expect that. Why wouldn't you? I mean, people are starting to realize there's real value in those batteries. I mean, really is a lot of value in those batteries. And you just have to remember one thing. We don't have to go out and stake a property, find an anomaly, drill it, come up with resources, then end up doing a feasibility study at the end of that game after we've done a resource study. And the years go by, and the costs keep getting higher and higher and higher as you get into the feasibility and the permitting and bond placing and all of these things that go along with trying to get a mine into production. So you're seeing a lot of cobalt in the ground. Cobalt Ontario is a good example. And one thing I'll say that's a plus for the miners there, I'm not sure about the Ontario laws, but in BC here, you can operate under a small miner's license. So if they do find a rich resource, it's maybe not as big as in the DRC, you may be able to mine within a couple of years under the small mines permit. So this doesn't necessarily say that every mine is going to have a huge resource study, have to have huge resources or feasibility studies to move ahead. When in reality, you could operate under a small mine permit. So that's a plus side for the explorers for cobalt, and we're we have a program going on. Remember, we got our finger in the Cobalt play that the Australians are going to be doing up on our property. And who knows? One thing I always liked about exploration was that you're only a drill hole away from something that could be totally a game changer for the company. And so, you got to think about that. When the drills start turning, you've seen it. You've seen discovery holes, and you see what happens with the market, and how all of a sudden you become the darling of the street. Well, we got our fingers in both camps, and as I've said before, the manganese is heating up. There's lots of talk about manganese. Well, we certainly have a huge finger in that camp, and it goes along with the critical metals in the U.S. But let's stick with the recycling. The recycling is where we could see some immediate cash flow, and the company could become a viable company that operates out of cash flow.
Larry, can you tell us where American Manganese is traded and how to contact you?
Okay, I'll do that, Jim. Just one more thing I want to say is when I was down at the show, I did 4 videos and 1 podcast like we're doing right now. And we've already put 2 of those out to our readers, a podcast and a very short video. And I apologize for the noise in the background, but I had nothing to do with the mechanics of shooting the videos or doing the podcast. But we've got 3 other videos coming out, and so I won't be doing a podcast next Friday because I'll be in California, and at the Bloomberg conference. So I won't be doing a podcast, but you should be able to get at least 1 or 2 of the videos that are being done out to our shareholders in the next week. And going back to the company, it's a critical metals company, and focusing on recycling lithium-ion batteries. We're listed on the Toronto Stock Exchange Venture under the symbol AMY. We're listed in the U.S. under the symbol AMYZF, and we're listed in Frankfurt under the symbol 2AM. Our website is AmericanManganeseInc.com, and you can reach me at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
Okay, Jim.
My guest has been Larry Reaugh, CEO and President of American Manganese. We were speaking on January 26th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Penny Green, co-founder and president of Glance Technologies. Welcome back to the show, Penny.
Thanks, Jim. It's a pleasure to be here.
And we have to let people know if we get a little bit of phone effect. Penny is talking to us from Davos, Switzerland. So please excuse any little technical burps you might hear. Penny, I hear Glance has received some exciting news recently.
Yes, Jim. We just recently announced a $5 million licensing agreement for Glance, which is our biggest licensing agreement so far to date. We have agreed to grant Fobi Pay Technologies a non-exclusive license to use Glance Pay, mobile payment security, anti-fraud, and Glance Coin blockchain technology for $5 million for a 1-year initial term, renewable annually for $10,000 a year. Now, the exciting thing is that Fobi Pay is a company that offers big data analytics for networks of related businesses. They take the purchase basket and historical data from a customer, merge it with social media and mobile data to create highly personalized customer journeys. So with license of Glance, Fobi Pay will be able to offer a closed-loop digital media and mobile strategy for big industry players.
So, Penny, can you expand on why big data is so exciting right now?
Sure. It's a big space, and it's getting more exciting, the IDC says that worldwide revenues for big data and business analytics will grow from $130 billion in 2016 to more than $203 billion in 2020, and that data monetization will become a major source of revenues as the world will create 180 zettabytes of data, which is 180 trillion gigabytes in 2025, up from less than 10 zettabytes in 2015.
Penny, can you tell us about the new company you just licensed to, PhobePay?
Sure. PhobePay is also licensing big data analytics, social Wi-Fi, and a real-time offers engine platform from Phobe Suite Technologies. So by combining the Glance and the Phobe Suite technologies, PhobePay will develop the technology for servicing a network of merchants localized around a common theme such as a shopping center or a professional sports league. And PhobePay has the potential to capture the data from receipts, combine it with online shopping histories, match it to social media profiles, and attribute the purchases to an individual shopper.
Penny, can you tell us how much Glance has done in licensing deals in the past year?
Absolutely, Jim. We've had a stellar year, and in fact, in the past 8 months, we've signed $9 million worth of licensing deals for Glance Technology.
Now, cryptocurrencies have seen a very severe correction. How does that affect Glance Coin?
Jim, Glance Coin is a cryptocurrency built on the blockchain, which is a business-to-business and a business-to-consumer solution to provide rewards. So the fact that cryptocurrencies such as Bitcoin and Ethereum have dropped significantly really has no effect. The blockchain revolution is here, and Glance is here to serve it.
Penny, you're talking to us from Davos, Switzerland. What are you doing in Switzerland?
Jim, I'm at the Crypto HQ Crypto Conference in Switzerland, which is an exciting conference bringing together some of the world leaders in cryptocurrency and blockchain to network and to share ideas on how blockchain can revolutionize society and business. Speaking here at a couple of events.
Penny, can you tell our listeners about Glance Technology for people who haven't heard about it?
Sure. Glance Technologies operates Glance Pay, which is a mobile payment system with proprietary technology that is built to handle billions of dollars of transactions and is currently operational throughout Canada. We are currently offering our mobile payment technology to allow individuals to pay using their phone at restaurants and in hair salons, and we're soon launching to retail.
Have you expanded your operations into the U.S.?
Well, it's interesting that you ask, as we've been making a lot of progress in that respect. We have offices now in New York and in San Jose, and we've been signing restaurants up, and we hope to be launching in the U.S. very soon.
Penny, where is Glance Pay traded?
We are listed on the CSE under the symbol GET, that's GET.
And how can people find out more about Glance Pay?
Go to our website, glance.tech or glancecoin.io, and we also trade in the U.S. under the symbol GLNNF.
Penny, thanks for the update.
Thanks, Jim. It was a pleasure.
We've been speaking with Penny Green from Davos, Switzerland. She's the co-founder and president of Glance Technologies. I'm Jim Goddard. We were speaking on January 22nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.